market. We are now joined by Robert Omotunde, investment researcher at Afrinvest. Thank you, Robert, for your time. I think let's begin in this interesting environment. We're a couple of weeks away from the elections, and when you look at both the main markets here, on the currency side as well as, fixed income side as well as on the equity side, you have seen sort of like, on the equity side, really the market sort of going nowhere but under pressure. On the fixed income side, though, rates ticking up a little bit. Where is the smart money to be made in 2015?
In 2015, it looks like it's going to be a very tough year, for investors, both at the fixed income end and the equities end. Of course, the concerns around the election that is going to take place in 2015, the two major political parties which are gathering momentum in order to win, supporters, for themselves. Investors are going to be considering these factors around the election, particularly around the falling oil price, which has more or less threatened the fiscal stability, of Nigerian economy. Now, against this backdrop, investors are demanding for higher yields. The country risk is getting higher. Credit risk is getting higher. Interest rate expectation for the future is also getting higher. So these are factors that investors are pricing. So against this backdrop, yields are getting higher.
So getting to the fixed income side, essentially is the message that you guys are projecting.
Exactly. It's getting higher in the sense that we have seen in a couple of weeks back, the high trending yield, particularly because investors are, weary of what the exchange rate is going to look like in the near term. So against that backdrop, investors are pricing on a higher yield. So, and then what we are saying for 2015 is that it's going to be a tough year, but there are opportunities for investors, to take position using some specific strategy, which we have, crafted into passive and active strategy. Okay. For the passive strategy, what we are saying is that, yes, we know that yields are high and they may continue to trend higher pre-election, but towards the end of by the time we see the results of the election and post-election, we would expect some moderation. Okay, so for a passive strategy, investors can take position at the shorter end of the curve, while they underweight on the longer end of the curve, so as to stay less affected by the higher yields, because as yields are trending higher, the prices of bonds, their investment, tends to be going lower.
Absolutely.
So what we are saying now for first half is that take position at the shorter end of the curve, but towards the end of post-election, we expect that
you can go along your long end.
Oil prices will have stabilized, by our estimation, and the headwinds around our polity will have also moderated. And so
that's the point I was going to make, that you guys essentially are saying that the first half is a write-off, so go short, and then try to see if we can make some money in the second half of the year.
Exactly.
You are assuming that by the second half of the year, the politics will be done.
Exactly. That the polity will be much more stable, and investors who have taken position at a, more or less higher yields, as yields tend to go lower, they tend to benefit from a rise in the price, of their investment.
How much more can yields go higher, do you think, given the uptick we've seen so far?
Our conservative projection is between 15 to, as in the large cap that we are looking at is around 15.5 plus or minus, 0.3%. So that's what we are projecting.
Do you see the central bank acting in this half of the year before the second half in any way? Some people are suggesting that it staved off action last week. I don't know whether it was deference to the politics or not, but the suggestion seems to be that after the elections there is likely to be some tightening. Is that what the market is pricing in?
Well, the market may be looking at that for now, but we also know that the CBN is also considering looking at the macroeconomic variables in order to take the appropriate decision that for the market. And what we are seeing in the near term, possibly the risk that investors will be pricing is a possible further devaluation, which will be premised on the falling oil price. If this situation continues, and then the CBN may have to take a much more drastic, action. So further tightening may still, may still be expected, in the near term. But for as long as the current dynamics are stable, the CBN is not likely to take any major tightening measure.
Okay, so its hand has to be forced, you are saying. Okay, let's move on to equities now. We've seen the market really, as I said, coming under pressure, but essentially going nowhere in a drastic way. What's your focus for the equities market? And are you adopting the same strategy as with fixed income?
Yeah, for the equities market is much more dicey in our opinion. So what we have seen in a couple of times, okay, last week we saw that market did about 2.7%. That's the first week-on-week gain that the market will return this year. And by our expectation, what we have been seeing in the market a couple of weeks back is investors taking position, identifying opportunities with low prices, taking position and then taking profit. So it's more like the market is going back and forth. The fundamentals are weak. I mean the macroeconomic fundamentals. So the events that have played out in the equities market are not necessarily reflecting the company's fundamentals, but more of macroeconomic headwinds. So what we will see in a couple of weeks is investors will be watching the market, check when prices are low, take position, then take profit.
Absolutely.
So it's more like the market will be oscillating.
It sounds like it's a trader's market, definitely. Unfortunately, we have to leave it there. We've run out of time. That's Robert Omotunde, investment researcher at Afrinvest.